Welcome back to another episode of Drilling It Down. This is your host, Wes Lyon. Co-hosting today, I have Mario Santiago. Mario, welcome back.
Thanks, Wes. Happy to be here.
Oh, absolutely. So, Mario, I sent you an article we're going to discuss today. So, kind of, if you don't mind, introduce the article and topic. What are we talking about?
Yeah, pretty interesting stuff. So the article is called Slash and Burn. Is Private Equity Out of Control? Super interesting read, and we just thought it'd be a good idea to take a deeper dive into it today, and specifically private equity and as it relates to dentists, but really just what private equity is as a whole.
No, definitely. And it's something we talked about in kind of last month's McGill and Lyon Dental Advisory, 3 things to avoid, and one of which was private equity. So I thought this article was kind of timely. I think it came out right after I actually wrote our article, which we touched on it briefly, but today's podcast, we want to touch on it in a little bit more detail. So what did you find interesting in this thing?
Yeah, it's just super interesting because when we talk to a lot of dentists, they just hear the word DSO, right? But there's also private equity, and there's DSOs that are backed by private equity. And I think it's very useful to read an article like this and just take a step back and understand where the money's actually coming from and where the decisions are actually being made, and then taking a deeper dive into how it affects the DSOs. But it's just super interesting. The article basically takes a deep dive and refutes the notion that private equity is really good for money, for people, for society. And it really talks about how one of the most interesting things I found is that the return in private equity investments maybe isn't as good as you just going out and investing in a low-cost index fund. I think that was the biggest thing that I found. But I'll ask you some questions, Wes, too, down the road. And I found this to be super interesting.
Definitely. And for those of you listening, part 1, we're going to concentrate on private equity as an investment. Now, some of this stuff is going to relate, but we're going to also record part 2 today, which will be out, about a week after part 1. And in part 2, we're going to really talk a little bit more in depth about how this impacts DSOs and selling to a DSO. But for today, we just want to dive in. If you're looking, whether or not it's, a dental private equity group or some private equity group that comes to you invest, want to figure out how does this stuff really work, whether the return stream's really there. My advisor approached me with something like this. Should I really do it?
Yeah. Well, I wanted to start off with, it might sound like a basic question, Wes, but can people out there listening to this today, can they invest in private equity? And if so, how does it usually happen? Like you said, do you get approached by someone? Do you approach someone about it? Is it something that's only available to, the wealthy and the rich? And is it a status thing?
Yeah, for those of you listening who don't know us as well, maybe first-time listeners, John McGill actually plucked me out of an institutional money manager. So that might be a good starting point of private equity firms are more of what I'd consider the institutional money managers. They don't really sell to retail as much. And where this comes in is most of you are going to get approached by a financial advisor or somebody, and that's how you would get into it. Some others, you may be able to get into it. Somebody may approach you, especially, if you got $25, $30 million, you might $100 million, they might approach you directly. Most people, though, they're not going to have access to this world outside of a financial advisor. But then this is where it kind of gets funny on, a lot of advisors sell this as access and they have ability into stuff. And I just crack up with access. I left my cell phone on the counter right here because, I've got a couple of CEOs' phone numbers in there. I've sat down, had lunch with these people. I know them. I've got one of them that calls me and is always, hey, we'd love to talk about this investment philosophy. So as far as access goes, it's not something that's wildly difficult to get access to as a financial advisor. It's actually very easy if you have a lot of money, to go ahead and get access to this stuff. I think a lot of advisors try to sell access and sophistication, and that's really how you get the access, though, or why it comes about. And whether or not you should do it is a whole different ball game. But
there's probably a lot of incentive if somebody tells you, hey, I got access to this thing that only you can invest in. And I'm guessing a lot of people find that very attractive.
It's sold that way. I don't know as many people, I don't know how attractive it is. I remember we were I got flown up to New York City with about 10 other partners at an extremely large RIA. We may have been, an RIA is a registered investment advisory firm. At the time, we may have been one of the largest. I used to work for one of the largest aggregators. So I get flown up there, and, there's, call it 10, 15 of these private equity firms. And, it's all the senior partners and me. And the senior partner I worked for thought it was funny to send me because I was a numbers guy. You're not going to skate something by me. I'm going to read every last detail of what we're getting into. So I would always ask questions and kind of the a-hole in the room to some extent of, this isn't going to work. So I was up there and, I kind of kept my mouth shut to some extent because most of it just didn't make sense. And I felt you just didn't get a good feeling from it. I remember there were, specifically, there were these two guys who they were young, like 28 and 26, and they were coming to sell their private equity fund. And it was, the premise of it was there were all these, in 2008, the financial crisis was created by a lot of mortgage-backed securities, and a lot of issues that went on there, credit default swaps, a lot of very, very complicated products. And then there were these things that were basically synthetic mortgage-backed securities. And by synthetic, we mean, hey, we don't actually own this or insure against it. However, we're going to pretend as if we do. So it was a makeshift security. And their whole premise was, hey, we can buy these and we know what's in them and we can make money off of them. So the natural question came up, well, what makes you two better at this than everybody else? And the answer was, we built them. And I was like, let me just get this straight. You two knuckleheads were probably 22 and 24. You were at some desk. You were creating these products. They helped blow up the economy. And now your sales pitch for your private equity fund is only we really know what's in them. And I just sit there. I'm like,
crap.
I cannot sit there in front of a client and tell them this is a good idea. This is the grimiest thing I've ever heard. Mm-hmm. So the CEO or the CIO, Chief Investment Officer of the whole firm, comes and sits next to me at lunch that day. He's like, Wes, what'd you think? I was like, Rob, this is grimy. Like, what are we doing? And I was always known, still am, I've always been my blunt self. So I just asked it, and I was pleasantly surprised at the answer Rob gave me. It was, I want to put $1 with these guys. However, our competitors are selling access to something, and we need to be able to say we also do this. Mm-hmm. But I wouldn't put client money there. And I'm just laughing. I'm like, so the whole thing is we need to be competitive. And he's like, you got it. Mm-hmm. So we've got this platform of availability, but even our chief investment officer, it's like it's just there because of how other advisors sell. But this access stuff, I just always laugh.
But the article dives into that too, about how it just bleeds into every industry, every company, almost to the point where it's hard to back out.
Yeah, that kind of gets into I think the access thing, just to kind of wrap that up and move on. The access thing is a joke. I always laugh. Like last time we were speaking, I just pulled up my cell phone. I'm like, look, these guys can get the sales guy on the phone. I can get the dang CEO on the phone, but I'm still not putting your money there.
Yeah,
You just won't catch me doing it, which I think maybe to get into that point, I think we need to talk a little bit more about what it is. Now, there was something in there for those of you listening. I did not get on the same page with Mario. I told him to read the article so I can quiz each other here on what you found interesting. There was something very interesting I found in there, and it had to do with the debt. Did you find that one?
Basically, how they use debt to finance all these operations. Yeah, I think, correct me if I'm wrong, but basically they use all this debt, but they put the debt, they don't actually have to assume the debt. The PE groups, they have the company that they buy assume the debt. And then some of these companies will go bankrupt and all this stuff. And then when they close the doors, the original PE investors still get paid out probably more than they put in, and they leave the firm in a worse spot. I don't know if I explained that well, Wes. But
that was a very simple explanation of what goes on a lot of times. And I think some of the famous examples in here were Sears. Like a lot of people wonder,
Toys R Us.
I'll get into the Toys R Us model because I have an article inbound about what happened there. It's little related to actually a dental DSO. I'm not going to name it, but I think the important part is, okay, they're going in, levering up these companies, stripping them down. Okay, what is private equity actually doing? And what they're really doing is trying to manage assets because they typically charge 2% of assets under management and 20% of profits, which is a pretty hefty fee. So they're extracting a lot of money from these PE groups or from the companies. But what they actually do is they go in and, gosh, we're going to have to look here. What was the number on how much of the money comes from investors versus debt?
It was a very small amount. Let me see.
Yeah, it was basically, we'll see if we can find it here, but on average, it's a very minimal amount of capital that gets in there that's not borrowed. Yeah. They're basically levering up and using the profits of the company to pay back the ownership of it. So they're not really invested with their own money at the same side of the table as the sellers are.
Yeah, I can't find the specific number, but
yeah, it's pretty hefty. We'll see if we can get it, but it's over like 3/4 of the money to buy a company comes from debt. Yeah. I want to say it was even like 7 out of every $8 used or something, but don't quote us on that one.
But if I'm hearing you correctly, a PE firm comes in to, let's just use a company like Toys R Us or whatever. They come in, they assume a ton of debt, but they have the company assume all the debt. They get paid out a management fee of 2%, and then they get the profits of like 20%. Then the company maybe goes down the hole and they back out, and they're not responsible for paying that debt, and they got their payout.
Exactly. They can leave the company in really, really bad shape and still make money. And a lot of people don't realize that, the private equity money on it a lot of times is sitting in their 2 and 20. It's not sitting on the return of capital to the actual people that put it into the private equity fund. So they'll strip down companies, take everything out for themselves, and maybe the investors get a paycheck. Maybe they don't. And they advertise these great returns. And don't get me wrong, they have great returns. It's just for who?
Yeah.
Like, is it really for you? And the answer of that is probably not.
Yeah. And I think it's interesting too, because the returns are clearly going to the people who already have a ton of money. But it sounds like also they have all these tips and tricks where I think I read that a lot of the money that they get, they can characterize as capital gains versus just profits, and they get to pay less tax on it. So they just keep on getting richer and richer off this kind of stuff.
Yeah, this is a political hotspot. So let me come back to that. I'm going to wrap this one up. But their basic model is to go buy companies with tons and tons of debt that they get from the banks. So they get the money lent to them. They straddle the companies with debt. It's something we call a leveraged buyout. So if you're wondering what a leveraged buyout is in financial terms, it's just assuming a ton of debt to buy a company. Somebody asked me if we were private equity back. They didn't know what's going on with me and John. I was like, well, if by private equity you mean I took the loans and I'm private, then yes. But that's it. We don't have anybody else in the walls here that's got their butt on the line, or somebody. It's just me with my butt on the line for what goes on. But are we private equity back? No, but that's all they're doing is they're taking the debt that somebody like me would have had to have taken. They're assuming it. They're coming in and running it. And their idea is they can run it better. They can make it more profitable, and they can leave it in better shape, which kind of leads into the next thing I think you're alluding to is, do they actually do that?
Yeah. And so if somebody approaches you about this, is it a worthy investment?
In my opinion, no, it's not. So couple issues here if you get approached with this. First is people need to understand how things get valued. If I buy a mutual fund of publicly traded stocks, they own these stocks. And I used to work for a very large mutual fund company, like 6th largest in the country. So when we value what your shares are worth, it's very simple. A mutual fund is a partnership, and you own whatever tiny percentage of it. If the mutual fund's assets that are publicly traded easy to value. And this would go for an index fund, right? If I bought a Vanguard index fund, my share of that index fund is whatever percentage of the fund that I own, which is going to be very tiny. I mean, these index funds are huge, but okay, at close of market, the shares were worth whatever 1.2 billion, and my little piece of it is worth 66,000. I have $66,000 in that mutual fund. That's it. It's plain and simple. You go to sell that mutual fund, you can get $66,000, and you can do it pretty much any day you want. The market is open. When you're in a private equity investment, they're valuing what they think the assets are worth. Now, they're charging a 2% assets under management fee. You think they want to value the assets lower or higher?
They're probably going to paint that rosier picture.
They do. And this is where it's really hard to track the returns. You know, there are a lot of benchmarks in there, talk about private equity returns. But a lot of those returns are recorded on the books. They're not actually realized. So a lot of people don't understand, you know, okay, I'm showing a 14% return, but it's money on a piece of paper that you may or may not see. The other thing they do is, you know, it's hard to get in there. There's not like clear, solid reporting standards of, oh, the fund made 14%. Was that before or after management fees? Mm-hmm. Right. We actually had a client come in and he had gotten scrolled into a couple private equity investments. And I was thinking we were about to have an ugly conversation. I said, hey, did you know about this? And he starts laughing, goes, it wasn't a ton of money, but I've learned my lesson. Yeah. And we're looking at it, you know, it's got a stated return rate that's pretty high. However, that was pre-fees. So you look, and the fund had $6 million of assets in it to start. The assets, I think, in the return had grown to be like $8.5 million, but the fees, management expenses that the private equity fund had charged over the time period was $2.5 million. So you actually looked, and the amount of money in the fund from the beginning to the end was the same, and yet they were claiming a positive return. And some people buy this stuff and they see it on paper and they don't know any better. And truthfully, I think a lot of advisors out there also get duped into this. They don't work. They've never had the institutional money management experience of going in there and actually figuring this stuff out, what the return was. And because of that, they see the returns and they kind of buy them without asking deep questions on, you know, like a lot of these private equity companies, you know, they'll show you, oh, here's our track record. Well, you got to ask more questions. Those are the ones that worked. Yep. What's the track record? How many funds did you shut down that you're not telling me about? And all these questions really tell not so great stories for most private equity funds. Yeah. So the problem isn't necessarily that they can't make money. They can make lots of money. The problem is who they're making it for. And it's very seldom that they're really looking out for the end investors in sight. I mean, it's insane how much they get paid at these private equity firms.
Yeah, and the other thing that was interesting, now that you mentioned about tracking their performance, you know, the article really said that only about 60, I think, percent or maybe half of all the private equity firms are actually tracked in terms of benchmarks. So we don't actually know what the other 40% or so is doing. And it's probably more likely that that other 40% is not doing so hot. So they're really only tracking maybe the best performers to show an overinflated return.
Yeah, and you're looking at the benchmarks there, right? There's not good benchmarks on this. That's where in public equity markets or publicly traded stocks, we have good benchmarks. There's oversight, you know, management, all this stuff goes on. You know, it's very rare a publicly traded company goes under because of this. So whole different ball game there, but yeah, that's exactly right. And I did get a good laugh in this article. I know this because working as an institutional money manager, we saw a lot of pension funds, a lot of things going on. And they mentioned how the pension funds, you know, they get higher returns. So they all invest in it. The truth is, and I won't call out ones I know about in there, but whether or not a pension fund is over, underfunded is public knowledge. You can go look this up. And they're going through, and they mentioned a lot of the ones investing in private equity that I know to be underfunded because of poor return histories of the managers. So they're sitting there and, you know, you might say, oh, this thing has a 11% return on paper, but then you look at the pension fund and it is grossly underfunded, and poor investment results have a lot to do with that. They don't want to admit to it, but it has a ton to do to it because we used to they all, there's all these standards on how to evaluate investment performance, and most of them are pretty screwy, if we're being honest. So they sit there and you look at it and you're going, well, how are you underfunded? And then they look at us, what's your 5-year track record? And we're like, well, this is our 5-year track record, and here's why. And in the stock market, there's characteristics, things we were doing to position portfolios away from an index, and it doesn't always work. We know statistically it'll work over a 40-year period, but over a 5-year period in the investment world, we call that noise. But that was all they cared about. And these private equity firms would come in to show them a 5-year track record, and they'd not show them all the other stuff, and they'd invest. And there's a lot of pensions in America that are just wildly underfunded.
Oh my gosh. And a lot of people relying on that, right? So
no, absolutely. Which I think this might be a good, this will be an example, a really, really good example of a private equity firm ruining a company but making profits. So you mentioned Toys R Us. I don't know, how familiar are you with the Toys R Us debacle?
Not as much as you. I'm about to find out.
So Toys R Us got bought by a private equity company. I don't know exactly when. Kind of got run into the ground. But I believe, and again, don't quote me on exactly on this. It's been a little while since I really followed this stuff closely. I don't work in that industry as much anymore. So what they did, though, was they sold the real estate and leased it back at ridiculous rates. And when they sold the real estate, the profit became in the real estate, but they straddled the company with all these, ridiculous rent
payments. Yeah.
But when they showed that profit on paper for selling it, they were able to take a huge chunk out. So Toys R Us ended up defunct, but the private equity companies ended up good. I mean, it's just not something. And I don't know that the investors ended up good. I do know that the private equity firm ended up fine. And, there's also, I didn't get into this, so don't use Toys R Us as a perfect example, but for the sake of not being sued by somebody who doesn't like what I have to say with a lot more money than we do, I'm not going to give specific examples, but I have them in my head, where a lot of these sale leaseback arrangements, there's a huge conflict of interest, and the company doing it is maybe benefiting on the other side of it. So they're making their money on the purchase of the real estate. Because I know there's a very prominent politician involved in this. And there's a lot of politicians involved in this, which will come into our last thing we want to talk about, which is taxation and why it exists. But there's a very prominent politician who is thought of to made his money in being a genius in private equity. What actually went on was when they were putting the European Union together, every member country had to have a balance sheet, or, it couldn't be running a certain amount of deficits. I don't know exactly the details, but what they did was they engineered a sale leaseback of all of the countries' major assets. So they really made their money. And what I would think from a bystander, you look at it and you go, that's corrupt.
Yeah.
There's nothing, you sold off all of the very expensive buildings, monuments of this European country to lease back. And when they do this, there's not the same accounting standards applied to this. They're applying governmental accounting standards. So they're showing the sales as revenue, even though it's not recurring. So that's an odd one as CPAs. You might not have realized the why behind that. But when you took the CPA exam, we don't deal with government accounting, but you knew there were two sets of rules. And it's just absurd that they're making money off of stuff like this. Again, I don't know what the investors did, right? He's not a commoner investment person. This person is a partner in the firm, and that's who's really extracting all the money out is, private equity's investment. If you're a partner at a firm, you're going to make a killing, absolute killing. But if you're just nobody investing in it, they're not out for you in it. So we really want to stay as far away as possible in it.
So my big question, Wes, is private equity good for all these industries, and I guess specifically dentistry?
I'm going to put that question back to you. And I love this one. And I think it was actually a practice broker that sent this out in an email. And I'm usually not this blunt about it because we'll talk about relates to dental practices. We're not necessarily against selling to a private equity firm. We just need to understand what we're getting into. But can you name one industry that's been gobbled up by private equity that you think runs better?
Yeah, no, I can't, especially after reading a bunch of this stuff. I'm not convinced that the actual industry itself is better, but people got rich off it. But I don't know if it was the people who actually worked in that industry. It's people that maybe had nothing to do with that industry.
No, definitely, which I think gets into why people sell to them. But if you think of like HVAC companies, plumbing companies, my gosh, I mean, I don't know if you rent, so you don't have to deal with this, but I always go out of my way to try to find the local guy. And a lot of people do. Like, I just want the local guy. And usually they're swarmed with work, so it takes a little bit more time, but they don't absolutely rip you off. Like, I had to get my driveway dug up. The sewage was going the wrong direction. And I was leaving, and I had two guys living in my house that my wife was super enthused about with COVID. They were supposed to buy a house, and then COVID hit, and they didn't buy one, so they were stuck living with me. But I'm leaving. The sewage is going the wrong way, so I call the person and get there in an hour. I paid a lot of money, like more than my wife's engagement ring, and had the next guy come about. And I asked somebody, I said, "Can you look at this, do whatever?" And he's like, "You overpaid," and I'm not going to really get into the details. So I had my whole driveway dug up, all the pipes replaced. So then I'm at a wedding like 3 weeks later, and I'm talking to a buddy I haven't seen in like 4 years, and he had the same problem. Moved into a house, the pipe burst underneath. So now you're going to dig up the driveway, and he tells me, "Dude, what are you talking about? They've got new technology where they can push something through that will expand, and they don't have to dig up the driveway." He was like, "It cost me $5,000 to get this done." I'm like, "I'm 25,000 in, and I haven't had the driveway repaved yet." I'm like, "What in the world?"
But that's the problem in a lot of these things. It's like, you as the consumer, you don't know these things, right? So historically, people trusted the advice that they were getting, and the problem now is there's money and incentives behind the advice where you don't trust it anymore.
No, definitely. So yeah, no, it's a tough one. I don't think it's good for anybody except for the people running it. And as you said in this article, it really gets into it. And I did like they had some data. They did admit that their data set is limited because this stuff isn't as publicly well known. I think if the returns to the investors were what they're supposed to be, they'd be a little more publicly well known. But yeah, they were like, I think over a 10-year stretch, you got like 0.5% more. And they acknowledged that they thought their data set was skewed to the positive, but you got 0.5% more than just investing in the S&P 500. And their point was a lot of this is more driven by just market returns than anything. As company values go up, you can get it in the public markets, you can get it here, but that return, we don't know if it's pre-management fees, post-management fees, what's going on. Everybody acknowledges that there's a level here of the onion that isn't unpeeled for most people. So in general, it's just a ton of risk to take for a marginally maybe better return, but you potentially lose everything.
Yeah. Well, at least we got a positive from it. You probably won't make that mistake with your driveway again. And at least I learned from it. Next time it happens to me.
But I think the American people are turning to some extent, and they really want a local person.
Yeah.
Or they want somebody who's running the company who's also, owns it. That's there to oversee it. Like, I found a new plumbing company, and I called them up, ran into another issue. They come out and they're like, "Hey, we have a $150 fee. And, if we have to do any work, the $150 is credited against it." So they show up, they figured out the problem within 30 minutes. They said, "Look, you don't have a major problem." And they're like, "We're not even going to quote you because it's under the $150. We just need this part, a little bit of labor. So you're going to get the $150 visit fee for an emergency visit. And that's all you're paying today." And I was like, awesome.
Great. Yeah.
Like, this is amazing. Last time I called a plumber, they were digging up the driveway for apparently no reason. And these guys, just like, no, we don't do that. We're here. We privately held company, this guy owns it, and he'd be down our throats if we sold you something that we didn't want.
Yeah, it's a reputation.
No, definitely. But yeah, no, it's definitely something I recommend staying against. And, there's a lot of investments out there like this. So it was actually part of, I've got this article or our newsletter right here. So if you don't subscribe to the McGill and Lyon Dental Advisory, highly recommend go subscribe. If you go to McGillHillGroup.com, you'll be able to find the newsletter, sign up, make sure you're getting this every month. You get valuable information on what you should do and what you shouldn't do. And every dentist really needs this. But then our last point as we go into this, why does this still exist? What are the benefits? And you mentioned the tax ramifications. And I kind of wove that into a lot of politicians are tied up in private equity, and that's not an accident. So do you know what they actually call this issue?
The tax loophole thing? Oh, man. No.
Carried interest.
Carried interest.
So we've had a whole lot of polarizing elections recently, so it hasn't come up. But this came up big time in the Obama-Romney one because Romney's a private equity guy. Bush was a private equity guy. Cheney. Obama has some private equity connections. I mean, it's everywhere. The senators, the Congress people, everywhere there are connections. And the real thing is what they're able to do is this money they make in their fees and their profit split, especially the profit split, they're able to call it long-term capital gains and something we call carried interest. So if we went out and we were able to make $50 million in a year, which we would never rip our customers off to that extent. That's insane. But if we made $50 million in a year, we'd have to pay ordinary income tax like every dentist listening to this. But no, they do it. And a lot of the times they get to call it carried interest and they just pay capital gains tax of 20%. So,
and I'm guessing these politicians are in the highest tax brackets.
It's so funny. I always love it. We don't care what side of the aisle you're on. But if you look on both sides, like, you've been in Congress for 20 years making $200,000 a year and you have a $200 million net worth. I'm sure carried interest has nothing to do with that because every election, it's this hot topic. We're going to shut down carried interest, shut this stuff down. And then the election happens, we move forward and we never hear another peep about it.
And they're basically cutting that tax bill in half, right? Because if they're at the top tax bracket plus state, you're 40% or above, but you're paying 20% on the capital gains.
I mean, you're saving 17% right off the bat. Yeah. So phenomenal for people that work in private equity. Not an investment we recommend getting into. But Mario, any other closing thoughts?
No, I think those are good ones to talk about. And like you said, we'll take a deeper dive at how it affects dentistry in the next episode. But I think it's really important to understand what private equity is and why people invest in it and why maybe not to invest in it.
Yeah, well, tune in. Make sure you hit the subscribe button if you're listening to us. Make sure you get that next episode out. We're going to talk about private equity in dentistry, something we talk about a lot, but I think it's always a hot topic and the tides are shifting a little bit now. And, hopefully if you've been listening to us for a while, you've understood that this stuff is what goes on. It's just, I found it a little fascinating that it's publicly out there. Yeah. So for next episode, we've got some great public nuggets we found that weren't on dental websites. We're talking about just like consumable to the general public, some things about what's going on. And I think they even did an investigation in Congress. So that's going to be fun to talk about. We're really looking forward to it. Thank you all for chiming in and we'll be with you next time.
All right. Until next time.